everyone, and welcome to Raising Millionaires. I am your co-host, Roger Bryan, with
Richard Lorenzen.
It is nice to be back with you all after a little hiatus from doing this. And Richard, like we said, we're using some new technology here. So I'm watching all kinds of like percentage uploading efficiencies, and I have no idea what that means. So I apologize as we figure out some new technology and try to improve this. Hopefully everything's working well. But today, we want to talk about everyone's favorite topic, the one that keeps them awake at night, the one that they're talking about at dinner with their spouses, their kids, their exes, their priests. Well, okay, maybe not their priests, but tariffs. It is all anybody can talk about in the markets today. And we're going to dive deep into them, what they mean for us, what they mean for you, what they mean for your investments, and what they mean for your financial future. Richard, how the hell are you?
I'm good. How are you, sir?
I would be better if I stopped looking at the CNBC app and the Coin Market Cap app, but that's what we're here to talk about. So
it's a very timely moment for us to be back after our 2-year hiatus.
Well, right out of the gate, we both own businesses. Our businesses have clients and suppliers. How are tariffs affecting you or your clients right now?
Well, yeah, I think, in a way they affect everybody at a macro level, right? As we unpack kind of what the impacts of tariffs are. Fortunately, we're in a lot of industries that aren't seeing, direct exposure per se. We work in financial services and technology where it's a little bit different as opposed to a manufacturing business or an industrial business, import, export. But at the same time, it's important to think about the macro impact that tariff policy has on pretty much everybody in the economy. When you talk about the inflationary impacts that it has, and then the domino effect of that inflationary pressure and the impact it has on interest rates and potentially even impacting GDP. So,
well, what about this? Like, okay, so I own an e-commerce business.
right.
And we're in the septic space, and everything comes from China, right? We've dealt with this at the beginning of COVID. A lot of people tried to move to American manufacturing. We tried to move to American suppliers on a lot of products. It tripled our costs and just was not viable. So here we are again, wondering how we're going to place our orders for the spring without having to increase prices 20 or 30%, which is unsustainable from a direct-to-consumer goods perspective. But like with your clients, and you talk about the macro, does that change their thought processing on investing in the type of services that you provide? That's always my biggest fear, is that the mindset shift can cause the economy to lock up. People don't want to spend in uncertain times.
Yeah, that's the $1 million question. That's the thing that
I
everybody.
think it's $1 trillion question. $1 million is like a drop in the bucket.
Exactly. Yeah, I mean it does. I think more than anything else, especially when you have all these headlines about recessions and inflation and fiscal tightening, it more than anything else right now, I think what you're seeing is impact on sentiment among business owners, among leaders who are thinking or rethinking maybe some of their investment strategy, some of their growth strategy for this year, for the next couple of years. And so I think, and you're seeing this reflected in equities right now. You're seeing fear out there as people try to figure out what exactly does this mean for my strategy over the next 12 months. And there's a lot of uncertainty around that too, because the tariff policies themselves seem to change almost daily.
I think Trump stumped his toe earlier and decided to double the tariffs on Canadian steel and lumber from 25% to 50%. Right? The market was just starting to get a little bit of no movement up, but it was a little flat today. And we'll take flat in today's environment. And then somebody fucking pissed in his Cheerios, and next thing you know, he's doubling tariffs again. So that uncertainty is one of the biggest problems. Mm-hmm. Here's the biggest macro question. Are tariffs a good idea? I want to add a context element to that, though. when your trade imbalance is as big as the Americans, as big as the United States, $130 billion a month in trade imbalance.
Mm-hmm.
I can't help but use the analogy of the drug dealer and the addict, right? The American consumer is a consumptionaholic. We want to keep buying, leveraging debt, whether it's at the government level or at the consumer level, at the business level, right? Whose fault is it? Is it the supplier or is it the consumer? Is there any realm where tariffs are a good idea?
Well, if you look at the national debt, right, what is the U.S. national debt up to? It's an absurd number that, I think has almost no likelihood of being paid off anytime, probably in our lifetimes, right? And so you look at trade imbalances and budget deficits, and I guess that there are some camps of people that look at that and will say, well, tariffs maybe are potentially a solution to evening out some of those trade imbalances, and so historically, tariffs have been used as a tool to address those trade imbalances. I think, from my view, something that's different though right now that we're seeing with the tariff policies that are being talked about in Washington right now is that depending on what day it is, sometimes it seems like the logic, the thought process for some of those tariff proposals, while in part might be trade imbalances and addressing those trade imbalances, there are also a whole host of other reasons that it seems like we're employing some of those tariffs for, and so whether it's talking about stopping the illegal flow of migrants across the southern border, stopping drug trafficking, fentanyl is one of those things that.
Well, no. Let's take the excuses out of the equation and throw it out because it's so ridiculous, right?
Well, that's the thing. But that's the thing right now. So the point is that these tariffs right now, the way that they're being used is different from the way that they've historically been used, because we're essentially the Trump administration is essentially using tariffs as kind of just essentially a tool to address any kind of foreign policy grievance that they might have with any.
Doesn't that diminish the value of their word? Like when Trump reacted to Trudeau, who of course is now out of office, and said that, right, we're implementing these tariffs because you didn't do enough to stop fentanyl and illegal immigration. And Trudeau comes back and he's like, dude, Trump, Donald, which was probably a mistake calling him Donald instead of president, 1%, right, or no, I'm sorry, less than 1% of all illegal immigration in the United States comes through Canada, less than 1%. And then he went on to say, do you know how much fentanyl came across the Canadian border and was seized in 2024? Richard, do you know the answer to this question?
My guess would be that it's less than 2%.
It's less than half an ounce.
Mm.
So it's like 0.0000001% of all the fentanyl that came into this country came across the Canadian border, right? I'm just seeing the ridiculousness of all of this BS. The question comes back to, is tariffs a good idea? You've basically said probably not.
No.
Right? Historically, it's proven, like in the 1860s, in the 1920s, anytime that there was a huge input of tariffs, typically you saw the greatest recession and the Great Depression, right? So historically, they don't work. In cases where other countries have implemented them successfully, they've done it like a VAT tax, a value-added tax or a consumption tax, which is typically started low, like say 2 to 5%. If you look at the fact that the total imports to the United States each month are $400 billion, right? If you put a 5% tax on that across the board, all imports, was that 20 billion? So that's $250 billion a year in revenue, $1 trillion every 4 years. Does that at least start paying down some of the national debt if you also cut costs and balance the budget? Maybe. Is it less chaotic than what we've got going on now? Absolutely. I don't know. If I was president, first off, we'd all be screwed. But second, I do think that a flat tariff, a flat VAT tax would be easier to digest for the American economy, for American businesses, for the world economy, and it might have some sustainable opportunities there. I don't know. What are your thoughts?
Yes, I think that I feel that the positive impact of even just a simple VAT tax probably wouldn't outweigh uh, lost whether it's inflationary impact, lost potential trade.
Do you
I
think
don't.
the 5% would actually have a major impact across trade?
I think in certain industries it would.
Mm,
If you look
okay,
at
that's fair.
certain industries, uh, yeah, I can't see. I'm a free markets guy. I can't see it being a situation where the benefits would outweigh the cost.
Okay,
Um,
here's a fun one. If we think about like this whole tariff thing initially was positioned as a Trump negotiating tool, like you said, for immigration, for fentanyl, whatever it's supposed to be. Then today, Trump comes out and says that part of the 50% tariffs on all, like on Canadian goods, is they can either accept 50% tariffs or become the 51st state, right? Steve Leisman on CNBC is losing it today. He said that is the most insane thing he's ever heard come out of a president's mouth.
mhm.
It is just absolutely insane that anyone can think that they can tell a country like Canada or even Greenland, right? You're going to become a state whether you like it or not.
Mhm.
Is that the world we live in? Is that the kind of craziness that we're going to have to deal with for the next 4 years?
I agree with you that it seems like a negotiating tactic, more so than a serious.
Become the 51st state? Or like, what's the like long game
But
there? Does Trump have a long game? Let me rephrase
if
all of this. Is
if
there a long game goal in this, or is this just insanity?
I don't know, I don't know. But if but
Neither
if
does anybody else,
but
right?
if but if you look at the trend over just the past what 6 weeks, 8 weeks now, what have we seen on the tariff side? Tariff ultimatums, threats that are that come emanate from the White House and are walked back 2 days later, a week later. Um, Clearly, there does seem to be some
That's
sort.
what we've seen
Yeah,
in the last 6 weeks. There's the
well,
markets
and
right
so
there.
that's the byproduct of the uncertainty that we're seeing of these tariff policies. That one day there's a 25% duty on something, and the next day it's being walked back because we had a great strong phone call and we're going to work together, right? And so there's some of that too, where if we're talking about the market and equities, like you have to start parsing through some of those headlines that you're seeing and you try your best to figure out directionally where we're going long term as opposed to the short term volatility, which is it was high under the first Trump administration and it's going to be high under this one as well.
One of the things that I did before this call, and I do quite often, is I'm always looking at the spreads on puts and calls. So right now, if you go in and you want to look at buying a call on MicroStrategy or strategy, thinking that at some point Trump is going to say something that's going to give the markets a bump, right? And you're trying to play the spread on that bump, the implied volatility. The pricing in all of that is so extreme, right? Normally you'd see in a weekly expiration like a 1 or 2% spread. It's like 5 or 6%. The volatility that's being priced in is insane, and it's going both ways, right? Whether you think it's going to go up or it's going to go down, 5 or 6% in either direction, it's
Yep.
too big of a risk to put
Yep.
money into, and it's crazy.
The volatility we're seeing right now, especially this week, and it's only Tuesday. Um, it's only Tuesday. Uh, the volatility that we're seeing this is not the kind of volatility in my opinion, to be trying to play a short term, like buy the dip.
Well, but that
Um,
violates the rule of short-term trading where volatility is key.
right, but if you're a
There's not
professional
uncertainty.
trader, great. But if you're not a professional trader, I think for the average investor, you're better served tuning out a lot of what you're seeing going on right now, even what you're seeing go on over the next 12 months, and focus more on your longer term strategy and being diversified.
This may have a good tie-in because both of us believe from a diversification perspective how big a role real estate plays. And then when you're investing in real estate, the interest rates, right?
Yep.
Some people have said in these pundits on CNBC that, right, all of this tariff stuff is driving down the 10 years, driving down the bond yields, and that in turn could force the Fed to cut rates because prices are going up because of tariffs, which are inflationary. Interest rates are going down. If they need to go down in order to counteract, could Trump be focusing in on interest rates as a metric of success? And then after this is all played out, no matter what happened to the stock market, he can come back and say, look, interest rate, the bond yield was 4.1%. I got it down to 2. Right? No. Is that a good thing? How much damage does he have to do to get us to that point?
So you're saying that Trump is trying to circumvent the Fed and indirectly, what scenario?
Would be smart if he was. I'm looking for some semblance of intelligence in this strategy.
Do you think that there is a scenario, knowing the Fed right now, Powell, do you think there's a scenario where they would cut rates in response to inflationary impacts from tariffs?
Only if it's baked into the data, not the perception of or possibility of, right? But if consumer costs go up because tariffs caused supply side pricing to go up, the Fed has no choice. Trump can't get them to do what he wants. Trump can't fire them, but he can force the economic modeling to justify or require rate cuts to balance the economy back out. It's just that if you do too much damage on that, then the saving grace of lower rates might not be enough, and we might end up in a recession.
It may be too little too late.
Most likely will be. Historically, 1860s, 1920s, like we have history to prove what happens when you do this craziness.
That would be a really long-term game. I don't know if that's the end game that the administration is playing, but
I don't know. I'm looking for something. Like if I can figure out the strategy, I can invest around it, both short-term and long-term. Just right now, there doesn't seem to be one. There just seems to be insanity.
I don't think there's a strategy. Like we talked about this yesterday. I think staying long-term horizon is the only way to ride out the volatility that we're seeing right now. Thinking long-term, there's also the reality that in 4 years we're probably going to have we are going to have another administration in 4 years, whether it's a Republican or a Democrat administration. I think in both cases, it seems likely that next administration wouldn't keep tariffs in place. So how do you ride out the next 3 or 4 years is really what I'm getting at. And I still think that on the equity side, maintaining a longer term outlook and seeing through and parsing some of these headlines is probably going to serve you better than trying to figure out how to game the spread on what Trump might do next. But there's also, you brought up real estate, and that's another, that's a good point as well to be thinking about, should I be diversifying asset classes? Rates are high. It's hard to buy real estate right now and to get it to cash flow, but maybe that's another asset class that, some investors may want to be looking at if they're concerned about their exposure over the next 4 years in equities.
Yeah, and there is, from a historical perspective right now, more net worth value in homes in America than there's ever been in history. You have a combination of rising values, but also high interest rates, so people aren't borrowing against it. So all of that equity is locked up. I look at this from let's go back. Do we think that we're going to see a recession in the next 6 to 12 months because of tariffs?
I don't think in the next 6 months. In the next 12 months, I don't think so. I feel like we'd be looking at like mid 2026 before you really start to feel. Now, does that mean that we don't psych ourselves into a recession sooner? Because how many of these tariffs have actually even taken effect? I don't know the answer to that, but I would imagine that it's not most of them. So many of them have been walked back a couple days after they were announced,
Or a
uh,
couple minutes, right?
for a
Day
couple minutes, right?
Trump doesn't do anything in days, man. It's all minutes.
So, do we end up, does it, do all these predictions about recession become like self-fulfilling sooner? And because of, businesses that start cutting investments into growth and laying people off, maybe. But I feel like we're still probably at least 12 months out until you see a real impact on GDP. But what's interesting is that did you see the Atlanta Fed? I think it was Atlanta last week or the week before. They revised their GDP estimates down for, I think, the current quarter that we're in, from a positive number. I don't remember if it was +1, +2%, to I think -2% or something like that. I'll try to find the headline.
Yeah,
But
that would
it's a
be a huge
drastic
shift.
reversal.
I tend to stay up on the statistics, and I've seen a lot of revisions, but that would be like a 400 basis point revision. What I did see recently, though, was a study that was done in 2016 that I thought was interesting. I think it was either 43 or 47% of recessions start in the first year of a new administration.
Yeah.
So if we're going to have one, historical probability would state that it would happen this year. Whether or not it got worse going into 2026 would be another question, but historical data would state we were most likely to see it happen this year. The reason that I brought that up at the tail end of interest rates and real estate, right? If you've got all this value locked up in homes and home prices stay steady, interest rates come down and the market goes down in a recessionary manner, could you see an unlock of value from homes come back into the markets as a buying opportunity? Or would that be a good, I don't know, would that be a cyclical trade for intelligent investors to unlock value one part of their portfolio and bring it back into another with opportunity?
The biggest problem and the dislocation in housing right now in single family housing is the lack of supply. And the biggest reason for that lack of supply is that people can't sell because if I own a house and I have a 2% interest mortgage rate, why am I going to sell that house and buy another one at 7%? So
Yep.
whatever the conditions are that drive rates down, I think, if we do see a meaningful reduction in mortgage rates, there's no doubt you're going to see a lot of inventory that gets unlocked and comes onto the market. Whether that becomes a buying opportunity or not, I think depends on what the rest of the economy looks like at that time, and that will be reflected in the pricing of that inventory. But yeah, historically, it's almost always been a buying opportunity when you've seen conditions like that in U.S. housing.
Yeah, and I think even like me personally, I got way too comfortable, like being in the Midwest where the cost of living is so low with low interest rates, right? Investment properties and modeling out the financial commitments to those was so easy. We had like an inverse mortgage to rent ratio where at 20% down, you could buy a house in like the 3 to 5% interest rate range and rent it out and cover the cost,
Yep.
right? Ride that for 10 years and you're clean and clear. Once you get north of 5%, those models break down. And when you get into 7%, it sounds crazy, but you go from a 10-year to a 20-year repayment on a 2% or just on 2 ticks, 200 basis points on the interest rates. And I would have never known to even model that out until it actually happens and you see how much 100 basis points difference is in interest rates. It's crazy.
Yep. Yeah, I mean, it's really difficult right now to buy real estate that cash flows at 7%. Either maybe you're rolling equity over from a 1031 and you've less financing on the next acquisition and you have lower mortgage payments and that works, or you're buying something at at a discount because it needs a lot of rehab. Beyond those two scenarios, it's difficult right now to get deals with cash flow.
Yeah, I've even noticed in our market that there's so many flippers and rehabbers that they're the opportunity. Like I feel like the price to value ratio is actually lower, meaning worse for houses that need rehabbed because people think they see the potential, whether it's there or not. It's kind of crazy. All right. So I'm not going to call this a debate. I had this conversation with my mother-in-law, who is very open to the idea that we have to go through this chaos now, or it's going to be worse if we face it in the future, right? Then last week on CNBC, Rick Santelli kind of said the same thing. He went off on everybody, and he's like, if we can't take some, and it almost seemed like he was going to drop an F-bomb, volatility in the markets in order to create sustainability in our economy and our debt and our trade imbalances for our kids and our grandkids, then what the, and it seemed like he was going to drop another F-bomb, but he's a pro and didn't do it, are we even doing here? Like, this is insane. Santelli and Steve Leisman, they're always contrarian in their views, whether or not it's actual or if it's just for debatable experiences. I think it's actual for both of them, though. But those are two extreme thoughts, right? If we don't do this now, is the price to pay just going to be that much worse later? Not saying that we're doing it the right way, but I'm also not saying I know a better way. But do we have to do this now?
I think it's good in principle, right? Deferred gratification for future benefit later on. But what kind of future are we talking about? Or what problem are we talking about solving? I guess you'd have to be going into that with the idea that, I think we all agree that the current national debt is a problem, right? Like
we could do a whole call on that because I don't think you can pay that down, right? We're beyond bankrupt.
Right.
Yeah. Every conversation.
But what exactly? Because I get that. I get that argument, and I understand. Again, like in principle, I would agree with that. But it doesn't feel like that's what we're doing here with the tariffs. The tariffs seem to just be like a battering ram for any foreign policy grievance that we want to try.
Absolutely. That probably is the best.
And so, like, if there were a solid economic argument, I haven't seen one yet, but I think that's kind of what we're getting at in this episode. Like, we haven't been able to come up with one. But if there were a solid economic argument for why, maybe some temporary pain now is better for long-term prosperity for the country, but maybe there's something to debate there. But I don't see how tariffs now even make sense later, unless you see that differently. Is it because we're going to eliminate the national debt? Or because I can't see how any tariff would be big enough to do that. Same thing as raising taxes, right? Like there's always the perennial debate around, tax the rich, raise taxes, increase the revenue base, close the debt is so out of control that the interest payments alone are bigger than what we spend on defense at this point. This year, I think it eclipsed. I can't see how any tariff or tax policy is going to fix the budget.
So let's use that to kind of like close out this call with like a two-part question. We'll both respond. One, how is this all going to play out at the macro? And then two, how is it playing out with your personal finance modeling, your investment modeling, how you're looking at the future of your investments, whether it be short-term or long-term? Feel free to go first on either of those.
Well, macro, I think, we're going to see a lot more uncertainty. There's going to be a lot of volatility in equities. And I think you'll even start to see some of this uncertainty bleed over into real estate as well. I think, you'll see as the labor market softens a little bit more, which it seems like it is, less people are going to buy houses, less people are going to spend money on discretionary things. And so I think in terms of asset markets, you're going to see a lot more volatility over the next 12 months or, over the next 4 years. If this is going to be the trajectory we're on for the next 4 years, I think it will continue. The volatility will continue. So macro level, there's a lot of uncertainty and it's almost impossible to predict where it's going to go because it just changes so quickly. In terms of like how I'm responding to it, as you know, like most of my investment focus these days is equities. So equities are taking a hit. Yesterday was a significant hit to the tech sector. Equities across the board. That at the Nasdaq was down like 4% yesterday, and I think
Insane.
we're probably down more than double that over just the past week. Would be my guess. I haven't looked at a chart. So the best thing in my mind, I'm a long term investor. I have a long term horizon. Um, I'm a big believer in index investing, and so you have to stay the course. There may be some opportunities to buy some of these lows. I'm not quite there yet mentally, but for now, I'm maintaining a long term mindset. I'm staying the course. I don't I don't see enough of a change in the fundamentals for me to make a serious shift in asset allocation. What about you?
No, it makes sense. And I'm going to start with my personal, and then I'll close out with like what I see as a potential for the macro. On the personal side, for me, I freed up 10% cash,
Hmm.
but this is for opportunistic investing. This is not for long term, because I do believe that the level of volatility that we're seeing, there is opportunity to create entry points on short-term investments, typically through options, whether it be in individual sectors or individual stocks. Like right now, the AI space is getting crushed, and it's continuing to get crushed by news out of China with things that they're doing, often overblown. And it creates opportunities for a quick 50 or 100% return on capital. Um, of course, nothing's guaranteed, and if you make the wrong call within 24 hours on an option, that money's gone.
You
But
like short term trades,
I do, but I mean, 10% of an overall portfolio isn't really too
right?
much to be in that. The rest of it, I think what I've learned from my past experiences is that in this type of volatility, I do still believe in a good long-term outcome. So I'm not adjusting the portfolio at all. It's staying exactly the same for myself, for the kids, other than freeing up some cash so that I can, I'll admit it, get a little bit of the dopamine fix as the markets go chaotic. I think it's fun. I would definitely be looking back into real estate if we could get mortgage rates, 10-year rates below 5% on investment properties. I think that would really open up for my modeling and allow for 10-year repayments. I'd be all over that again, knowing that I didn't take advantage of it well enough last cycle, because you have low rates for so long, you think they're going to go on forever, and then they're gone, and you're like, shit, I should have done more. Now, the big picture stuff I think is a little bit more interesting to me. Um, in an ideal scenario, we settle on a flat tariff rate that is reciprocal across the world, right? And it just that becomes the new normal, and it creates an income stream based on American consumption. If we can get $250 billion a year in of that style tariff tax that can be applied to the budget, then we balance the budget. We close the trade deficit with more manufacturing in the United States. That's kind of wishful thinking, because I know as a business consumer, right, e-commerce business buying products from overseas, that if I insource, bring to the United States my needs, I have to pay triple the cost, which means my supply costs are higher than my current retail sales costs. No,
Hmm.
that model will never work, right? I can't triple my prices. Um, but tariffs balance out and it become an income stream. There's a big core part of this that Trump's doing that I think might work out well for us. Close the trade deficit, balance the budget, and then the last thing is the only way we're ever going to get out of debt is the sovereign wealth fund. When properly implemented, and Trump is doing this, but he's doing it in the most chaotic way, right? Mineral resources rights in the Ukraine, right? We gave them $400 billion. Should we get that money back with interest? Possibly. That's historically, that has happened quite a bit in wartime efforts.
Hmm.
Um, can we, for lack of a better word, buy the rights to the resources in Greenland? Denmark pays them $500 million a year for those rights, right? We can pay $1 billion. We can pay $2 billion if we think that there's hundreds of billions of dollars locked up in there that we're going to have access to. Put all that into the sovereign wealth fund, right? let the U.S. take all the seized assets that it has in the crypto space, put it in the sovereign wealth fund. As a longtime crypto investor, I do want to see the U.S. buying, right? I was super disappointed with all of the Trump fanfare and how he sold the crypto community on this sovereign wealth fund for him to come and say, well, we're not going to actually buy any. We're just going to take what we have and put it in there. But you start adding this up, 400 billion here, 100 billion here, 200 billion there. The sovereign wealth fund could have $1 trillion in value in it by the end of this year. And if you continue to do that, if you continue to find ways to add value to the sovereign wealth fund, now let's lay this all out. $250 billion a year in a VAT style tariff tax. Very easy, would not blow up the economy. It would cause prices to rise, increasing inflation, but that would cause the Fed to decrease rates and could open up capital for the rest of the markets. We go in and we figure out a way to close the trade gap, right? VAT tax might do it, but it's going to be reciprocal. The consumer will absorb it. We'll move on and we'll probably still have it. How do you close that? U.S. manufacturing, energy sustainability, a lot of different variables there. Got to balance the budget. I don't know the last time we had a balanced budget. Did Reagan do it? Has it happened since the 80s?
I believe it was 92 under Clinton.
Under Clinton?
Yeah.
You figure he was buying a lot of cigars then. You sure that didn't throw it out of whack?
Well, let's find out. When was the last time?
But balancing the budget, and Trump they're slashing, right? They're doing it in a very chaotic way. I don't like the way they're treating veterans and all of this and things like that. But I don't know. It's not affecting me directly, so I don't know directly. Although I am worried that my health insurance costs are going to skyrocket if they do something with the Affordable Care Act. And then the sovereign wealth fund, right? You do all of that, and I feel a little bit more comfortable about my kids and what they're going to inherit.
Good points.
I do think, though, that the sovereign wealth fund with debt management can start to, what's the Fed? The Fed has they carry a lot of assets to balance out the economy. I'm having a brain fart.
Yeah, their balance sheet.
Yeah, on their balance sheet, but they use quantitative easing, right, to layer out the economy. If you take some of those efforts and you turn it into asset appreciation through buying the assets and put them into the sovereign wealth fund, right?
Yep.
There's countries that have trillions of dollars. Let me take that back. There's at least a couple countries with over $1 trillion in a sovereign wealth fund. Why wouldn't the United States have a $50 trillion sovereign wealth fund? If we can put ourselves under the trajectory in the next 20 to 50 years to have that, and that we can use that to eliminate debt and stay out of debt, right? Fanciful thinking. We'll see a world war well before that happens. Something can come from all of this. But that is a lot of wishful thinking, and no one has laid out a strategy that says they're even considering all those variables. I hope they are, but I don't think they are.
Yeah, I mean, those are all good points. I think that also that there's an argument, there's probably a little bit of a difference between balancing the budget and which puts us on a track to paying off the debt, which is something that's very good that we want to do, but then also balancing trade deficits with individual countries that I think maybe, I'm not an economist by any means, but there may be some arguments around why it may not be such a priority to try to balance some of those trade imbalances with China, for example. And so because the US currency is the reserve currency of, for the most part, most of the world, right? Most countries use US dollars for purchasing oil, all sorts of different things. The trade deficit that we have with China and other countries is what allows that US currency to get out there into those other countries to use the dollar. So does resolving some of that trade imbalance threaten the dominance of the dollar as the global reserve currency? Is something that I've thought about.
It's an interesting point, but if we're sending $2 trillion a year out of the American consumer's wallet and taxpayers' benefit to foreign countries through consumption, that dollar strength equation, we've been doing this since the 80s, right?
Yep.
And it's hard because in a concentrated manner, there's a wealth increase in the United States, but it's not to the benefit of most.
That's a good point.
And I am not one of those people that believes everybody should be equal and that billionaires should give all their money to other people. Like, no, they worked for that. But, right, as those imbalances happen throughout the world and all of our money gets sent out through our consumption, we're the consumer addicts.
That's a good point.
We got to cut off the fucking supply.
Last question, which because this hasn't come up surprisingly during the whole interview. We talked about real estate, we talked about equities, crypto, macro outlook on crypto real quick as it relates to what we're seeing go on over the past week or so with.
Man, we went very, very heavy around September of 2023 in anticipation of the ETFs, which we've seen 400% return. Brilliant. But then stuck with it based on Trump's election and him saying that he is going to set up a federal crypto reserve, which he did. But I do think we got railroaded as crypto investors when Trump decided that it was only going to be on seized asset and not on buying net new, right? We were looking for, when I say we, I think the crypto, Bitcoin, and like macro markets were looking for U.S. being a buyer of the asset. And they still could be, right? Trump changes his mind like most people change their, like, I don't know, I think he changes his mind more than people change their underwear. And it could still be that there's a buying opportunity. What I want to see is an arms race by governments to buy and hold Bitcoin the same way gold was in the 70s. Building up those massive macro reserves of a limited supply asset, right? If that happens, we were forecasting a 250K Bitcoin by the end of the Trump presidency. He's kind of thrown us off by not doing what we expected him to do, but that's what Trump does.
So Bitcoin was about 100,000 when Trump came into office, roughly. Right now we're sitting, I think somewhere, I checked it earlier this morning, maybe in like the mid 70s. Do you see, short of the arms race, which isn't materializing yet, do you see a catalyst to buy this dip?
Catalyst to buy the dip? No. Okay. Right? If it starts going in the other direction, it is going to be based on a macro shift in strategy by the Trump administration that you can't forecast, right? You have no idea when it's coming. Bitcoin is a risk-on asset, so you're going to continue to see pressured selling if the rest of the market is decreasing. So if I would give it a hold rating, right? Long-term outlook, still good. I'm not a seller here. I haven't sold any through all of this. Well, you know what? Hold on. I do have to take that back. We did sell some as part of Q1 to fund the kids' 529s and life insurance, cash flow life insurance policies, but that happens every Q1. So it wasn't a net new decision to liquidate some. It was based on every January we have to do that. So I'm a holder, but I've been for a very, very long time. We have clients that offer to pay us in it. And from a cash flow model perspective, it has not become attractive enough based on risk to accept payment in that manner and not put it into the bank account, use it to pay bills, use it to invest in the business. I'd only take it as not a side payment, but only take it as a payment if it's going to sit in that account and grow in value.
Got it.
You didn't warn me. It's not on our interview questions.
Well, we can't not talk about it, considering the movement in the market. So right now, markets are basically flat. They've been up and down all day.
And there was news about a ceasefire opportunity in the Ukraine, that the Ukraine has agreed to terms. Well, you know what? No, the markets were down 400 points when we started this. NASDAQ was flat. Dow's down 180. NASDAQ's up 200.
You're seeing that right now? It's up right now?
Yep.
I'm seeing Dow down 200. Is that what you just said you're seeing?
Yep. Yeah. But NASDAQ's now up 200, and it was flat when we started the call.
Oh, wow. That's interesting. Okay, my browser just refreshed, I guess. Yeah, we're up.
I don't know. MicroStrategy's up 9%. Remember I told you it was a 5 to 6% spread? So it's now on the other side. See, that's the thing right now. One piece of news, right? A potential ceasefire that the Ukraine has agreed to, but Russia is not even part of the conversation yet. and now the markets jump enough to cover the spread on some of the calls. It's hard to play that, right? It's very hard because now if Russia in the next 68 minutes comes out and says, you know what, no, and starts a new drone assault, the markets go back the other way. If they say yes, we could see a 10% bump.
Yep.
At least 4 to 5% cross markets.
Yep. It's a risky game to play. Are you buying any dips right now in just S&P?
No, I look every day. I look around like 3:30, right when I get home before Claire gets off the bus. I run through what my watch list. I start to look at the option spreads, and I start to play the scenarios out from a risk perspective, risk reward ratio. And sometimes I jump in, right? After DeepSeek made some home runs, but I just can't get a clear enough picture on the uncertainty to be comfortable with big investments. $2,000 or $3,000 here and there on an option, no big deal. Usually you can get out of them pretty quickly, and I'm doing very short expiration on them same week. So I try to do Monday, Tuesday, Wednesday at the latest for a Friday expiration, but I want to be out the next open. So that means I've got to be right. I've just got to be right on what's going to happen overnight. And my crystal ball is still broke. I can't wait to get it out of the shop. But that's how I'm looking at it.
Got it. All right. I think that's a good place to close it.
All right. Everyone, thank you for joining us for Raising Millionaires. This is episode 5, right?
I guess so. It's been so long, I don't really remember.
I know. Our last one was like 18 months ago. I don't know if it was that long ago, a year ago at least. But excited to be back. There's so much to talk about. I know as Richard and I were talking about bringing this back online, we were thinking like Trump is going to give us so much to talk about for the next 4 years, right? We're never going to be short of interesting conversations.
Yep.
All right. Thanks, everybody.
Thank you.